Welcome and get ready to dive into some incredible tools to help improve your trading strategy. Today, we are going to talk about the best Heiken Ashi indicators that can take your trading game to the next level. By the end of this discussion, you will understand exactly how these indicators can make your trades more successful and how to apply them for better results. So stick around because there is a lot of useful information you will not want to miss. Let us get started. Before we dive in, imagine if there were a way to filter out all the noise in the market and clearly see the underlying trend. That is where moving averages come in. Moving averages are one of the most popular tools in trading, and they help you do exactly that. They are a great way to smooth out all that price data, kind of like how Heiken Ashi candles work. Together, they are even better. You can use either a simple moving average or an exponential moving average on your Heiken Ashi chart. Now, imagine this. If the price is above the moving average and the candles are showing green, that is a sign of a strong uptrend. But if the price drops below the moving average and the candles are red, then you have got a clear downtrend on your hands. Using moving averages this way makes it easier to see the overall trend, and it also helps you stay away from false signals that might get you into a bad trade. Now, let us expand on some chart patterns that can further enhance your understanding when using moving averages and Heiken Ashi together. One of the most common patterns you will see is the double top or double bottom. A double top looks like an M shape and signals a potential reversal from an uptrend to a downtrend. When using moving averages and Heiken Ashi, you can confirm the reversal more effectively if the price falls below the moving average and the Heiken Ashi candles turn red after the second top forms. A double bottom, which looks like a W shape, signals a reversal from a downtrend to an uptrend. If the price rises above the moving average and the Heiken Ashi candles turn green after the second bottom forms, that confirms the potential reversal. Another important chart pattern to watch for is the head and shoulders pattern. This pattern consists of three peaks, the middle one being the highest, the head, and the other two on either side being lower, the shoulders. It signals a potential reversal from an uptrend to a downtrend. This pattern often appears after a strong uptrend and can be a warning that the trend is coming to an end. The left shoulder forms as the price rises and then pulls back. The head forms with a higher peak, and the right shoulder forms as the price makes a lower high before starting to decline. When combined with moving averages, you can identify a stronger confirmation if the price falls below the moving average and the Heiken Ashi candles start turning red after the right shoulder forms. Additionally, if there is a neckline connecting the lows between the head and the two shoulders, a break below this neckline further confirms the reversal. There is also an inverse head and shoulders pattern that works the opposite way, signaling a potential reversal from a downtrend to an uptrend. This pattern is typically seen after a strong downtrend, indicating that bearish momentum may be fading and a reversal could be on the horizon. The inverse head and shoulders pattern consists of three troughs, the middle one being the lowest, the head, and the other two on either side being higher, the shoulders. Look for the price to rise above the moving average and the Heiken Ashi candles to turn green after the right shoulder forms. Additionally, a break above the neckline, which connects the highs between the head and the two shoulders, is a strong confirmation of the reversal. Combining the neckline breakout with a color change in Heiken Ashi candles provides a more robust signal for entering a long position. Triangles are another powerful chart pattern. Ascending triangles usually signal a potential breakout to the upside, while descending triangles often signal a breakout to the downside. When you spot an ascending triangle forming and the price breaks above the resistance level while the Heiken Ashi candles are green and above the moving average, this can be a strong indication of a continuing uptrend. In contrast, if you see a descending triangle with the price breaking below the support level, along with red Heiken Ashi candles below the moving average, this suggests a continuing downtrend. Flag and pennant patterns are also useful when combined with moving averages and Heiken Ashi. A flag pattern forms after a strong price movement and usually suggests that the trend will continue in the same direction. If the price is above the moving average and Heiken Ashi candles are green, and you see a flag pattern, it could mean the uptrend will resume once the flag pattern completes. Pennant patterns work similarly, and when confirmed with moving averages and Heiken Ashi candles, they can help you stay confident in the trend direction. Using these chart patterns along with moving averages and Heiken Ashi can give you a more detailed picture of what the market is doing and where it might be headed. The moving averages help confirm the trend, while the Heiken Ashi candles make it easier to visualize the price action and stay away from false signals. Keep an eye on these chart patterns and consider how they can fit into your trading strategy for even greater accuracy and confidence in your trades. Now, let us move on to something that can really help you understand the strength of price changes. This is the Relative Strength Index. The Relative Strength Index measures how strong recent price changes are. It is especially helpful for spotting when a trend is running out of steam and may be about to turn around. Picture this. You see Heiken Ashi candles showing an uptrend, but the Relative Strength Index is above 70. That could mean the asset is overbought, and a reversal could be right around the corner. Let us talk about a few specific chart patterns that you can use alongside the Relative Strength Index for more accurate signals. One such pattern is called bullish divergence. Bullish divergence occurs when the Relative Strength Index is making higher lows, while the price is making lower lows. This indicates that bearish momentum is weakening and a reversal to the upside could be near. When you see this divergence along with Heiken Ashi candles turning green, it becomes a very strong signal to consider entering a long position. On the other side of things, if the Relative Strength Index is below 30 and the candles show a downtrend, it might mean the asset is oversold and could be ready to bounce back. Another useful pattern is bearish divergence, which happens when the Relative Strength Index makes lower highs while the price is making higher highs. This tells you that bullish momentum is weakening and that a reversal could be approaching. If Heiken Ashi candles start turning red during a bearish divergence, this can be a good time to consider a short position. The Relative Strength Index is also useful when you spot double top or double bottom patterns. For a double top, if the price forms two peaks while the Relative Strength Index forms a lower high, it suggests that the buying pressure is weakening and a reversal could be imminent. Similarly, for a double bottom, if the Relative Strength Index forms a higher low while the price forms two troughs, it indicates that selling pressure is weakening and an upward reversal could be on the horizon. The Relative Strength Index is an amazing tool for getting the timing of your trades just right, especially when combined with these patterns. Next up, let us discuss another powerful tool called the Moving Average Convergence Divergence. It sounds complicated, but it is really all about showing the relationship between two different moving averages. The Moving Average Convergence Divergence is all about momentum. Here is how it works. If the Moving Average Convergence Divergence line crosses above the signal line while the Heiken Ashi candles are green, you have got a strong uptrend. The opposite is true when the moving average convergence divergence crosses below the signal line and the candles are red. This signals a potential downtrend. This indicator is helpful for making sure you are getting into trades at the right time and not jumping in too early. Let us expand on some key chart patterns that can be effectively used with the moving average convergence, divergence, and Heiken Ashi. One important pattern is the bullish divergence. A bullish divergence occurs when the price makes a lower low, but the moving average convergence divergence makes a higher low. This often signals that momentum is shifting and that a reversal to the upside may be on the horizon. If you see this happening while the Heiken Ashi candles are turning green, this can be a very strong signal to enter a long trade. On the other hand, a bearish divergence occurs when the price makes a higher high, but the moving average convergence divergence makes a lower high, signaling potential weakness in the uptrend and an upcoming reversal. If the Heiken Ashi candles are turning red during a bearish divergence, this can be a great opportunity to consider shorting the market. Another important pattern is the zero line crossover. The moving average convergence divergence has a center line known as the zero line. When the moving average convergence divergence line crosses above the zero line, it confirms bullish momentum, especially if the Heiken Ashi candles are also green and showing a trend. Conversely, if the moving average convergence divergence line crosses below the zero line, this indicates bearish momentum, and if the Heiken Ashi candles are red, this gives an even stronger confirmation of a downtrend. You can also use the moving average convergence divergence histogram to spot changes in trend strength. The histogram represents the difference between the moving average convergence divergence line and the signal line. If you see the histogram increasing in height while the Heiken Ashi candles are green, it indicates that bullish momentum is gaining strength. If the histogram starts to shrink, it suggests that momentum might be weakening, and you should be cautious of a potential reversal. The same applies in a downtrend, with the histogram growing more negative, indicating stronger bearish momentum. Using these chart patterns with the moving average convergence, divergence, and Heiken Ashi helps you spot momentum shifts and potential reversals more effectively. Make sure to watch for divergences, zero line crossovers, and histogram changes. All of these can give you valuable clues about the strength and direction of the trend, helping you time your entries and exits with greater precision. Moving on, let us talk about the Bollinger Bands. These are all about volatility. They have a middle moving average and two outer bands that move based on market volatility. When you put Bollinger Bands on a Heiken Ashi chart, you will see that when the candles get close to the upper band, it could mean that the market is overbought. When they get close to the lower band, it could mean that the market is oversold. If you see the candles breaking out of those bands, it can often mean that there is a big move coming, either a continuation of the trend or a reversal. Bollinger Bands are fantastic for spotting opportunities and understanding when the market is getting ready to make a move. Another great tool that works well with Heiken Ashi is the parabolic stop and reverse. This one is easy to recognize because it plots little dots either above or below the price. When the dots are below the Heiken Ashi candles, the trend is moving up and the trend is strong. When the dots switch to above the candles, that is a signal that the trend could be reversing. The parabolic stop and reverse is great for figuring out when to get out of a trend and time your exit perfectly. Have you ever found yourself staying in a trade too long and losing profits? This tool can help you prevent that. Now let us explore a tool that does not just show if a trend is up or down, but how strong that trend is. This is the average directional index. The average directional index does not tell you which direction the market is going, just whether or not it is trending strongly. When you use it with Heiken Ashi, it becomes very powerful. If the average directional index is above 20, that means the market has a strong trend. If it is below 20, the market is probably ranging. This is useful because Heiken Ashi works best when the market is trending strongly. If you know the trend is weak, you might want to stay out and avoid getting caught in a choppy market. This indicator helps you make sure you are only taking trades when there is a real trend in place. To make the most of the average directional index, let us expand on how it works with common chart patterns. When you see a double top or double bottom forming, the average directional index can help you confirm whether the potential reversal is valid. For example, if a double top forms and the average directional index starts dropping below 20, it indicates that the trend is losing strength, which adds further confidence in the potential reversal. On the other hand, if you see a double bottom forming and the average directional index rises above 20, it means the new uptrend has strength and could be a good opportunity to enter a long trade. The average directional index also works well with head and shoulders patterns. During the formation of the head and shoulders pattern, watch the average directional index to determine the strength of the trend. If the average directional index starts to decline during the formation of the right shoulder, it suggests the existing uptrend is weakening and a reversal might be imminent. Conversely, in the case of an inverse head and shoulders pattern, an increasing average directional index after the right shoulder forms can confirm that a strong new uptrend is beginning. Triangles are another chart pattern where the average directional index is extremely useful. In an ascending triangle, if the average directional index is rising above 20, it confirms the strength of the trend and a breakout to the upside becomes more probable. For descending triangles, if the average directional index is rising and above 20, it indicates strong bearish momentum, making a breakdown more likely. The average directional index is also helpful when looking at flag and pennant patterns. These continuation patterns often form after a strong trend, and the average directional index can confirm whether the trend is likely to continue. If the average directional index remains above 20 during the consolidation phase of a flag or pennant, it suggests that the trend is still strong and a continuation is likely once the pattern completes. However, if the average directional index drops below 20, it may indicate that the trend is weakening and caution is needed before taking a position. Using the average directional index with these chart patterns can greatly enhance your ability to identify strong trends and avoid weak ones. By keeping an eye on the strength of the trend with the average directional index, you can increase your chances of entering trades at the right time and staying out when the market conditions are less favorable. Combining this with Heiken Ashi makes it even easier to visualize the market dynamics and execute trades with greater confidence. Let us switch gears and talk about the stochastic oscillator. The stochastic oscillator compares the closing price to its range over a certain period, and it is very useful for identifying overbought or oversold conditions. If Heiken Ashi candles are showing an uptrend, but the stochastic oscillator is above 80, then the market might be overbought. This means a reversal could be coming. If the stochastic oscillator is below 20 during a downtrend, it means the market may be oversold and a bounce could be on the way. This is a great tool to help you time your trades better when the market seems like it has gone too far in one direction. We cannot forget about Fibonacci retracement. Fibonacci levels are a fantastic way to spot areas where the price could reverse or continue a trend. When you see a retracement happening in a strong trend on your Heiken Ashi chart, you can use Fibonacci retracement to find areas where the trend might pick back up again. Let us say the price drops back to a key Fibonacci level, such as the 38.2%, 50%, or 61.8% level, and then the Heiken Ashi candles change color. These key Fibonacci levels often act as strong support or resistance points, and a color change in the Heiken Ashi candles at these levels could be a clear signal that the trend is continuing, and it is a good time to enter. For example, if the trend was initially upward and the price retraces to a Fibonacci level before the candles turn green again, this can signal a continuation of the uptrend. Fibonacci retracement is a powerful tool for pinpointing precise entry points during pullbacks, allowing you to jump back into the trend at the right time. Additionally, combining Fibonacci retracement levels with other indicators, such as moving averages or the average directional index, can add further confirmation, giving you even more confidence in your entry point. So let us recap what we have learned today. We have talked about using moving averages to help confirm trends, using the relative strength index to spot overbought and oversold conditions, and how the moving average convergence-divergence helps you track momentum shifts. We have explored Bollinger Bands for understanding volatility, the parabolic stop and reverse for timing exits and trend strength, and the average directional index for knowing when the market is trending strongly. We have also looked at the stochastic oscillator for finding potential reversals and Fibonacci retracement for perfecting your entry points. Additionally, we expanded on various chart patterns that are key to successful trading, such as double tops and bottoms, head and shoulders, triangles, flags, and pennants. By understanding these patterns, such as the M and W shapes of double tops and bottoms, the structure of head and shoulders patterns, and the breakouts that happen with triangles, you can further refine your ability to identify strong trade opportunities. These indicators and patterns all work well with Heiken Ashi to give you more confidence and precision in your trades. As you start using these Heiken Ashi indicators, remember that practice makes perfect. The more you use these tools, the better you will get at spotting high probability trades and timing your entries and exits. Take some time to try out each of these indicators, see what works best for you, and keep practicing. You can engage and ask questions or share your experiences if you have tried any of these strategies. Let us keep learning and growing together. I wish you the best of luck on your trading journey, and remember, stay confident and keep working on refining your strategy every day.